Bank of America just threw a warning at the car market that most people are still treating like a niche story. I do not think it is a niche story. I think it is one of the clearest windows into what is really happening to the American consumer, to bank behavior, and to the broader economy underneath all the polished headlines. When I look at this market, I do not just see cars. I see debt, I see denial, I see a credit system trying to keep volume alive by stretching terms, hiding losses, and pretending that arithmetic can be negotiated with. And I have seen enough cycles to know that when a market starts relying on extension, distortion, and fraud just to keep basic transactions moving. The problem is never just the market itself. The problem is that the market has become a mirror. The car market is now reflecting something much larger. It is reflecting a consumer who is exhausted, over-leveraged, and increasingly unable to absorb the cost of living that was normalized during and after the pandemic. It is reflecting banks that still need to write loans, still need to produce interest income, and still need to keep the appearance of normality intact, even when normality has already broken. And it is reflecting the oldest danger in finance, which is this. When you cannot solve an affordability problem, honestly, you start solving it cosmetically. That is what I think is happening. Now, the warning at its core is simple enough for anybody to understand. A startling share of borrowers with auto loans are deeply behind. Not a little late, not a missed payment they can recover from, casually deeply behind, 90 days behind. In many cases, 60-plus day delinquency rates in subprime that are already worse than what we saw around the old financial crisis. That alone ought to make people sit up straighter, because a car is not some abstract speculative asset to the average household. A car is how people get to work. It is how they stay employable. It is how they keep the machine of daily life functioning. When people stop paying the loan on something that's central to everyday survival, the message is not subtle. The message is that they are out of room. Now, if the story stopped there, it would already be bad enough. But it gets worse because the banks are not responding the way healthy lenders respond to a deteriorating book of business. They are responding the way strained systems usually respond. They are extending, they are pretending. They are stretching loan terms out to levels that tell you the underlying payment cannot be supported inside a normal time frame. That is why those 84-month terms matter so much. 7 years. Think about what that means, not for a house, for a car, a depreciating machine that loses value the second it leaves the lot and keeps losing value long before the borrower has meaningfully paid down the principal. Nobody should look at a 7-year car loan and conclude that the market has become more efficient. A 7-year car loan is what you get when the price is too high, the buyer is too weak, and the lender still wants the deal to happen anyway. That is not efficiency, that is desperation made contractual. The sales pitch is obvious: longer term, lower monthly payment. That is what makes the vehicle seem possible. But the monthly payment is only the bait. The real cost sits underneath, because the longer that loan runs, the slower principal gets paid down up front, and the more time the car has to collapse in value while the debt remains stubbornly elevated. That is how negative equity becomes a way of life. And negative equity is not some technical inconvenience. It is a trap. It is the condition where the borrower owes more than the asset is worth, which means the borrower cannot trade out cleanly, cannot sell cleanly, cannot absorb a mechanical failure cleanly, and cannot escape the deal without bringing cash they usually do not have. That is why I pay so much attention to loan, to value ratios. When half of used car loans are being written at over 120% of the value of the vehicle, you are not financing transportation anymore. You are financing a lie. You are financing the illusion that the consumer can afford the car because the payment has been engineered into existence, even though the value underneath the loan does not remotely support the amount being lent. And once banks agree to finance above value, dealers are naturally encouraged to price above value. That is how market discipline disappears. The bank says yes to more than the car is worth. The dealer charges more than the car is worth. The buyer walks away with a monthly payment he barely survives and a balance sheet that is broken from the first day. Then people act shocked later when defaults rise. I am not shocked. The whole structure practically announces where it is headed. And right now, according to the numbers, that destination is becoming harder and harder to hide. A meaningful portion of auto debt is already over 90 days delinquent. That should not happen at the scale we are now discussing unless lenders are dealing with a genuinely stressed borrower base. And in a properly functioning market, once borrowers fall that far behind, the collateral starts getting recovered, the car gets repossessed, the loss gets recognized, the bad loan becomes visible, but that is not happening as cleanly as it should. Why? Because the system is clogged and the system is afraid. There are not enough repo drivers to keep pace with the backlog. There are lenders and large used car platforms that do not want to trigger the optics of an obvious repo wave. So instead they lean into what banking always leans into when it wants to delay recognition: extend and pretend. Pretend the problem is temporary, pretend another call, another month, another accommodation, another workout. Another extension keeps the loan alive. Pretend the borrower is still salvageable. Pretend the asset is still worth what the original structure implied. Pretend the clock is not telling the truth. That phrase, extend and pretend, tells you almost everything you need to know about the psychological condition of a credit cycle. You use it when you know the loss is there, but you are not ready to drag it fully into the light. And so the headline delinquency numbers are almost certainly cleaner than the lived reality underneath them. There are loans that should already be recognized as dead but are still being carried as though some miracle is waiting. Just around the corner, miracles do not usually show up in lending. Cash flow does, and right now the cash flow is breaking. Then you add in something even uglier: fraud. Whenever a system becomes too tight for ordinary participation, bad actors start looking for ways around it, and technology now makes that easier than it used to. One of the ugliest pieces of this current market is the rise of credit washing. The mechanics are simple enough: a borrower with terrible credit disputes derogatory items all over the place, not because the disputes are legitimate, but because while those items are under review, they can temporarily disappear from the report. If that process is spammed aggressively enough, especially with the help of AI tools that can automate and scale the paperwork, then a truly weak borrower can temporarily look prime. A 500 score can start looking like something far cleaner. Then the borrower walks into the dealership during that temporary window. The lender sees a better file than actually exists. The car gets financed, and by the time the bureaus sort out the fraud, the borrower is already on the road in a vehicle he never should have been approved for in the first place. That is not a small side story that tells you the market is now stressed enough that a meaningful share of applicants are trying to hack their way through the front door because the honest route is no longer available to them. And it tells you the system itself has become too slow and too overloaded to defend its own underwriting standards in real time. Whenever fraud starts becoming normalized as a financing technique, you are no longer in an ordinary credit environment. You are in a decaying one. Now layer all of this over the timing issue, because timing matters. A lot of the most reckless car loans were written around the worst possible moment, during and after the pandemic. Prices for many vehicles became absurd. Production was constrained, supply chains were distorted, inventory was thin. Dealers slapped market adjustments onto ordinary cars as if consumers were bidding on rare art. A vehicle with a sticker of $50,000 was suddenly $70,000, and people paid it, not because they were fools in the cartoonish sense, but because they were in a distorted world where transportation had become scarce, financing had become the bridge, and everybody was telling them that if they did not act now, the next car would cost even more. Then the inevitable happened. The buyer drove off the lot, the market adjusted, the car stopped being a story and became a used vehicle again, and the gap between what it was worth and what was owed turned grotesque. Now we are moving into the part of the loan life cycle where defaults tend to become most dangerous. That 40 to 42 month zone matters because by then the borrower has had enough time to experience life with the payment, with repair costs, with negative equity, with economic pressure, with income strain, and without the psychological novelty that made the purchase feel worthwhile in the beginning. The excitement is gone. The payment remains, the car is older, the balance is still offensive. That is a dangerous combination, and the people who bought during the wildest part of the price spike are now arriving right at that zone. That is why I think the market is not at the beginning of the pain. It is entering the pain as most revealing phase, which means this warning is not about some hypothetical future problem. It is about a problem that is already mature enough to show itself. Now, whenever I look at a credit market like this, I ask the same question: who still has the incentive to keep the machine moving even when the machine is clearly straining? The answer is obvious: banks, lenders, large auto retailers. Anybody whose income model relies on loan origination, interest income, volume, and the recycling of trade, ins through the rest of the ecosystem. If they stop writing the loans, the whole chain starts tightening immediately. The dealers cannot charge what they have been charging. The banks cannot make what they have been making. The retailers cannot sustain the throughput they need. So the pressure is always to find one more way to keep the buyer eligible, longer terms, higher LTVs, more flexibility, more accommodation, more creative underwriting. But every one of those moves solves today. S appearance problem by worsening tomorrow, S balance sheet problem. That is what people misunderstand about credit cycles. The system can look cooperative right before it looks broken. The cooperation itself is often a sign of weakness, and the large players know it. When companies begin increasing loan loss provisions, they are telling you with their own money what they may still be softening with their language. They know consumers are missing payments. They know recoveries will be ugly. They know the collateral is not going to bail them out cleanly. They know some of the repos they eventually collect will come back in terrible condition and sell for much less than the paper assumed. That is why reserves start rising, because management may smile on the conference call, but accounting usually whispers the truth first. Now, I want to widen the frame one more time because people make a mistake when they hear about a stressed market like this. They think it only matters to car dealers and borrowers. It does not. Cars sit at the junction of household finance, labor mobility, bank credit, used asset values, consumer confidence, and regional business health. When auto credit starts fracturing, it tells you that the consumer is weaker than the broad averages suggest. It tells you inflation did more damage than headline improvements imply. It tells you wages did not keep up with the real costs that matter. And it tells you lenders are having to reach further and further just to preserve the illusion of normal demand. That is why I take this so seriously. The American economy has become increasingly dependent on consumers being able to keep borrowing, keep rolling, keep stretching, keep refinancing, keep pretending one more monthly payment can be made if the term is long enough. At some point that breaks. And when it breaks in a market as psychologically important as autos, people start revising how healthy they think the whole economy really is. Even the small used car dealer sees both sides of it. Maybe some buyers who can no longer get financed at the big lots drift down market and start showing up with cash scraped together from wherever they can find it. That may create a little demand at the low end. But the other side is brutal. If people cannot roll into new loans, they do not trade in their old vehicles. If they do not trade in their old vehicles, the auction lanes get thinner. If the auction lanes get thinner, the lower-end dealer gets less inventory and often worse inventory. So even the apparent winners in a tight credit system are usually being squeezed from another direction. That is what a real systemic stress looks like. No clean winners. Just different forms of pressure moving through the chain. And I think that is what Bank of America's warning really points to if you strip away the surface. This is not just about repos. It is not just about subprime borrowers. It is not just about fraud. It is not just about market adjustments that were too greedy during the pandemic. It is about a consumer economy that was asked to survive price inflation, wage strain, high rates, and depreciating assets all at once. And that survived for a while by borrowing against a future that never arrived. That future is arriving now, but in the wrong form, not stronger incomes, not better affordability, not cleaner balance sheets. Instead, it is arriving as delinquency, hidden losses, negative equity, soft fraud, longer terms, and the quiet recognition that the entire structure got too comfortable with making bad loans look serviceable. That is always the beginning of the end of a cycle. The loan still exists, the payment still exists, the accounting still says the asset is there, but economically the truth has already moved on. And once enough people realize that at the same time, the contraction speeds up. So when I hear a stark warning about auto repossessions and delinquencies, I do not file it under car news. I file it under consumer strain, credit exhaustion, and delayed recognition. And those are exactly the kind of conditions that tend to matter much more broadly than people think. Because by the time a credit problem becomes obvious in something as visible and essential as the car market, there is usually much more stress sitting behind it than the headlines are ready to admit. That is why I would pay attention now, not later. Now, because once the pretending ends, the numbers tend to move much faster than the public expects. And right now, this market is full of pretending.